Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about WD-40 Company quarterly report. WD-40 Company maintains a market capitalization of $3 billion, broadly in line with the industry peer group. WD-40 Company trades at a higher price-to-earnings ratio of 30 times and a higher price-to-book ratio of 10.41 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. The company maintains a moderate leverage profile, with liabilities making up 44% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The WD-40 Company offers a diverse range of products and services across various industries. At the core of its business are maintenance products under the WD-40 multi-use brand, which include aerosol sprays, non-aerosol trigger sprays, precision pens, and liquid bulk form products. In addition to these multi-purpose products, the company also provides specialty maintenance products under the WD-40 Specialist brand. These products cater to specific needs such as penetrants, degreasers, corrosion inhibitors, greases, lubricants, and rust removers. The 3-in-1 brand is another significant offering from the company, providing drip and specialty oil lubricant, as well as specialty maintenance products. The WD-40 Company also has a presence in the home care and cleaning market with various brands such as 2000 Flushes, Spot Shot, Carpet Fresh, Lava, Solvol, X-14, Novac, and 1001. These brands offer automatic toilet bowl cleaners, carpet stain and odor eliminators, room and rug deodorizers, bar soap and liquid hand cleaner products, and spot stain cleaners. The company sells its products through a wide range of channels including hardware stores, automotive parts outlets, industrial distributors and suppliers, mass retail and home center stores, value retailers, grocery stores, online retailers, warehouse club stores, farm supply, sport retailers, and independent bike dealers. The WD-40 Company's stock price has experienced a significant decline of over 13.98% in the past year, primarily due to its first fiscal quarter 2026 earnings report. The company reported financial results that fell short of Wall Street's expectations for both earnings per share and revenue. Specifically, diluted EPS decreased by 8%, net sales increased by only 1%, and operating income declined by 7%. Furthermore, the Asia-Pacific segment saw a notable 10% decrease in sales due to timing factors within its distributor network. The Cone 2026 earnings report triggered a significant single-day drop of approximately 8.1% to 9.5% in after-hours trading. However, this decline is part of a broader trend that has been impacting investor sentiment over the past year. Concerns over profitability and sales performance, particularly in certain regions, have led to a cumulative downward trend that exceeded the 13.98% threshold. Despite reaffirming its full-year fiscal 2026 guidance, the company's stock price continues to reflect these underlying concerns. The primary drivers of revenue growth or decline can be identified from the extracted summaries. On the positive side, sales growth in maintenance products worldwide, favorable changes in foreign currency exchange rates, and increased sales volume from successful promotional programs and marketing activities in China contributed to revenue growth. Additionally, new distribution within the first quarter of fiscal year 2026 also boosted revenue. On the other hand, revenue decline was driven by a decrease in WD-40 multi-use product sales on a constant currency basis, sale of HCCP, timing of customer orders in distributor markets, and lower sales and gross margin in Asia-Pacific. Higher operating expenses in EIMEA and unallocated corporate also contributed to the decline. It is worth noting that some factors had a neutral impact on revenue growth or decline, such as net income decrease due to higher employee-related costs, decrease in interest income, increase in interest expense, and increase in provision for income taxes. Net income and profit margins. A comparative analysis, the net income of the company experienced a decline between 2024 and 2025, with a decrease of $1,474, minus 7.8%, from $18,925 to $17,451. This reduction in net income is attributed to various factors, including a potential decline in profit margins due to no change in revenue data provided. A closer examination of the profit margins reveals that they decreased from 54.8% in 2024 to 56.2% in 2025. However, this increase in gross profit margin may be misleading, as it does not necessarily translate to an overall improvement in profitability. In fact, the operating profit margin decreased by 7% to 15.1%, indicating a decline in income from operations. The decrease in net income and profit margins can be attributed to various factors, including changes in revenue, expenses, or operational efficiency. The exact reasons for this decline are not explicitly stated in the provided data, but it is clear that the company's profitability has decreased over the past year. The company's financial performance indicates a positive trend in its operating cash flow. As per the latest available data for the 3 months ended November 30, 2025, the net cash provided by operating activities stands at $9,985. This significant amount of cash generated from operations is a key source of liquidity for the company. The substantial operating cash flow is further reflected in the company's cash and cash equivalents balance as of November 30, 2025, which amounts to $48.6 million. This robust financial position enables the company to meet its short-term obligations and invest in future growth initiatives. Overall, the data suggests that the company is generating positive operating cash flow, indicating a healthy financial situation. The company's debt level has undergone significant changes over the past period. While total liabilities decreased by $12,061 on page 3, this decrease was offset by an increase in total borrowings from $86,995 to $90,995 on page 18. However, a more substantial change occurred on page 35, where total debt increased by $4.8 million. In terms of interest expenses, the company has seen a notable decrease. On page 4, interest expense decreased from $873,000 to $648,000, resulting in a reduction of $225,000. This trend continued on page 33 and page 34, with interest income increasing and interest expense decreasing by $225,000 or 25.7%. Overall, the company's debt level has increased significantly, while its interest expenses have decreased substantially. The company's performance varied across different segments and regions. On the positive side, the Americas saw a notable increase of 19% in income from operations, indicating strong growth in this region. In contrast, other regions struggled to keep pace with the company's expectations. The EIMEA segment experienced a decline of 9% in income from operations, while the Asia-Pacific region suffered an even more significant drop of 22%. These poor performances highlight areas where the company needs to focus its attention and resources to improve results. Management is optimistic about the company's outlook and strategy. The company has a share repurchase plan in place, authorizing up to $50 million of outstanding shares to be acquired by August 31, 2026. This indicates confidence in the company's financial health and ability to invest in itself. In terms of growth, management expects progress towards cost reduction targets and adjusted EBITDA goals over time. The company's efficient business model is seen as a key factor in its ability to navigate uncertain economic conditions. Management will continue to monitor liquidity, customer and supplier health, and implement strategies for growth to ensure the company remains competitive. Overall, management's comments suggest a focus on financial stability, cost reduction, and strategic growth initiatives. The company appears well-positioned to manage through challenging economic times and is committed to investing in its future success. The company has made no acquisitions, but it is considering divesting certain assets from its home care and cleaning product businesses. As of November 30, 2025, these assets are classified as held for sale. The expected benefits from the divestiture include increased efficiency and reduced costs. The company anticipates disruption to its business due to the announcement or completion of any divestiture transaction. However, it is confident in its ability to successfully complete the planned divestitures. The expected timing for closing these transactions varies, but the company expects to generate significant proceeds from them. These proceeds will be used to strengthen the company's financial position and potentially boost its stock price and earnings per share, EPS. The impact of any divestiture on the company's stock price, or EPS, is also being closely monitored. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends. According to the provided information, the company has indeed paid dividends in the past. This indicates that the company values its shareholders and is committed to returning value to them. In addition to paying dividends, the company has also engaged in share buybacks. Share buybacks are a common practice among companies looking to return value to their shareholders. The company has purchased treasury stock through share repurchases, which suggests that it is actively working to reduce the number of outstanding shares and increase earnings per share for its remaining shareholders. That concludes the financial summary for WD-40 Company. Feel free to comment below, and I will be happy to answer them when possible.